Now, here are your hosts, Dominic Tavella and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, August 15th, 2023, and I'm on, as always, with my partner, Dominic Tavella. Welcome back, Dominic. How are you?
Yeah, Mike, not as always, so I appreciate you covering the home base last week without me. But yes, I am back from my vacation and looking forward to being here with you this evening.
Well, good. Well, I hope you had a great time, and you really didn't miss very much, as you know. Since the beginning of the quarter, the market's kind of been languishing, just kind of been flat. Quarter to date, before today's sell-off, the S&P was down a half a point. So I didn't do the math yet today. Let's assume that's flat or maybe even a little underwater. The Dow was up about 2, and the NASDAQ was down about 1. So we were expecting this. Maybe we thought it'd come a little sooner, but August, as we talked about last week on the show with your substitute co-host, David Walker, one of our advisors, we talked about the market looking for a reason just to slow down, take a breath, and it looks like we've got one now.
Yeah, so definitely on vacation, but obviously still paying attention. So last week you both had the S&P and the NASDAQ down, not dramatically, but the NASDAQ was down almost 2% for the week. It made for the second week in a row that the S&P and the NASDAQ were down. Nothing dramatic, as you pointed out. Today was a little rough. We'll see how we finish out this week. But as we said, Mike, we've been saying for a long time, the market had maybe gotten a little bit ahead of itself. And some of these high flyer stocks have pulled back, still up a lot for the year. But the Magnificent Seven have pulled back somewhere in a range of some of them about 15%, Mike. But the markets have been relatively well behaved so far.
You know, it's interesting. One of the indicators that the market uses, Dom, is a volatility index, the VIX. And the VIX has been relatively calm. You know, it's been trading at under 20 for really most of the year now. And even the last couple of week or two, it was at 13 and change. Now it's at 16 and change. It's gone up a little bit, but there isn't really, I don't know if people are not paying attention or they're on vacation like we were, but it doesn't appear like people are, or investors, I should say, are overly concerned about the activity. I don't even know if they're paying attention, quite frankly.
Yeah, and I think that's part of the problem, Mike, and we're going to speak about it with Greg tonight. But this is seasonally a time when things get a little bit quiet. People are away. Traders are away from their desk. They're on vacation. So you're going to get a little bit more volatility. And we said we've seen some pullback in some of those really high flyers. But, nothing horrific, nothing terrible. But I do think volatility and the VIX do get much worse over the next couple of weeks. Again, seasonality more than anything else.
Yeah, and another note, as you know, we use the JP Morgan weekly recap as our cheat sheet every week. And what they pointed out, what David Kelly and his team pointed out on yesterday morning, was as of last Friday, the top 10 stocks, you called them Magnificent Seven, he has 10 in there, accounted for 90% of the gains year to date.
Yeah.
Through Friday, which is remarkable.
Yeah, Mike, we brought this up and we'll talk about it again with Greg in a little bit. But, everybody's like, oh, the S&P is doing great. The NASDAQ is doing great. And we keep focusing on that, even though the market has broadened out, which meaning more stocks have participated in this upside. The majority of the stocks that we're talking about, let's call it 7, 10, doesn't matter. Call it an even dozen. I'm okay with that, Mike. But they're responsible for the bulk of the gains this year. And so it's a little bit, the major indices, a little bit deceiving. But, the issue we're dealing with today, again, is the same thing we've been talking about for a year. Inflation, interest rates, where the Fed is going to go. But again, good news maybe being bad news. And we got pretty good numbers, retail numbers. We've gotten good employment numbers. We've gotten good inflation numbers. I think it's just, generally speaking, a time for the markets to take a breather.
Yeah, let's expand upon that a little bit. I think good news being bad news is everyone is waiting, which seems now for a very, very long time, for the Fed to say, okay, we're done raising interest rates. We're done. We're officially done. And if we keep getting strong economic data, it gives the Fed a reason to take pause and say, well, maybe we shouldn't be done. So I think, I don't want to put words in your mouth. I think that's what you mean when you say good news is bad news.
Yeah, you're exactly right, Mike. So the economic data we've been getting has been relatively more positive than negative, which means the inflation pressure will be greater for longer, giving the Federal Reserve the excuse to continue raising interest rates and probably more important, keep them higher for longer, Mike. Remember, we started the year with many of the Wall Street experts talking that we would see 2 rate cuts by the end of this year. I think the market at this point has realized that that's highly improbable. Highly improbable.
Look, let me just point out, higher for longer is not necessarily a bad thing. Now we'll get Greg on here, Greg Dalhman from Dana Investments, but all higher for longer means is that the economy still has not deteriorated, right? It's hung in there, and maybe we have a short recession, maybe we have no recession, but higher for longer to me, it doesn't have to be a bad thing.
And we brought this up in prior conversations. We run balanced portfolios, and for our purposes, that means some of the portfolio needs to be in interest-bearing bonds, some need to be in stocks. And having bonds that are paying us a reasonable rate of return for somebody like us, Mike, this is giddy. This is good news. For a decade, we've had to figure out a way to give our clients a reasonable rate of return. We're finally getting that reasonable rate of return on the fixed income bond side of our portfolio. So I don't think this is bad news. What the Fed does here going forward is anybody's guess, but we're keeping our fingers crossed at this point. They're going to be responsible and not over tighten and push the economy into a recession.
Right. Because to your point, if they do over tighten, and then we are going to have those interest rate cuts, because now the economy is starting to deteriorate. And I think you and I heard the same report this morning when we were heading into work, how the Fed is really in uncharted waters in relation to interest rates and the job market, because by now the Fed would have anticipated that the job market has deteriorated as well. And again, we sound like broken records. It really hasn't yet.
Yeah, and that's been probably the most unusual part of everything we've experienced over the last 18 months. And the employment numbers have remained relatively strong. And as such, the consumer continues to spend. And now they've refocused where they're spending their money on, Mike, but they're continuing to spend. And that's kept the economy rolling along. It's pretty,
well, yeah,
pretty
but yeah, they're traveling. I know you were in Europe last week, and what I've read is everyone's in Europe.
Mike.
Everyone's in Europe.
I jumped on a plane to go. Obviously, I didn't swim, but jumped on a plane to go to Europe. And believe me when I tell you, there was not a single seat available, a single seat open. I traveled regionally within Europe. There was not a single seat available, a single seat open. And walking through the streets, it seemed like half of the world was walking along there with me. So clearly, tourism in general, travel is not diminishing anytime soon.
So you walk in the streets of Italy and you hear some Brooklyn accents and Carolinian accents and Texas accents.
I will, again, in full disclosure, Mike, way more Spanish, German, Russian, every language you can think of. The world is taking advantage of the freedom. And I'm sure the same thing is happening in France and in Portugal and in Spain as it is in Italy. The world is traveling again.
But that's great news. And that's what I've been reading. So tonight's guest is Greg Dalhman, who's a senior vice president at Dana Investments. You've been doing business with them for, I think, 20 years. We've been doing business with them for a long time. The firm manages $8 billion. So we have some catching up to do if we want to catch up to them. Greg is involved in some way, fashion or another, managing about 5 billion of that. So, a lot of it's large cap, but we are looking forward to his thoughts and comments. We talked before the show, and he has some positive views, I think, that I think our clients are going to enjoy hearing, Tom.
Looking forward to this. Love hearing from the experts.
So we'll be right back with Greg Dalhman, Senior Vice President at Dana Investments.
Lebenthal Report. If you have any questions or comments, please send an email to contact@lebenthal.com. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner, Dominic Tavella, and our guest this evening, Greg Dalhman, Senior Vice President at Dana Investments. How are you, Greg?
Great. Yourselves?
Good, thank you.
Welcome back, Greg. Thanks for joining us this evening.
Happy to be here.
So, Greg, let's start with an easy question. Soft landing, hard landing, or no landing?
Well, I've been in the camp, guys, for pretty much the whole year that it's going to be no landing, only because when you look at, we've never had a recession when you've had employment growth as strong as what we're dealing with right now. And as you all see, the statistics come out every single month. Employment growth is defying almost every economist's projections. When interest rates go up, the general consensus is the economy softens. That's not necessarily happening this time, which is fairly unusual. But as long as employment growth continues at the level that it's at, I think it's no landing.
And Greg, just as a quick follow-up to that, there obviously were some pretty well-known, well-established equity strategists, portfolio managers that were really talking about doom and gloom with earnings for the S&P 500, and that doesn't look like it's been all that bad. The earnings have held up pretty well.
Well, if you want, Don, what I'd say is, I would say that, this has been a year where where the vast majority of the big strategists got it wrong and were too bearish going into the year. Time will tell if the Fed goes too far to push us into what we call an economic recession. But I would say candidly that I think what happened last year is at Dana, we're strong believers that stocks follow earnings and revenue over the long term. And we've definitely been through an earnings recession. As you noted, it hasn't been very deep, but we've actually had 5 straight quarters of year-over-year negative growth for the S&P earnings in aggregate. So I would argue that we've been through an earnings recession. A couple of strategists that I really respect, a guy named Ed Yardeni, who's on CNBC quite a bit, he argues that there's been rolling recessions throughout the economy where, as the economy shifted, think about how all of us lived during the pandemic when we couldn't go out and travel or go out to eat or what have you. We all bought stuff. Now, most of us have bought more stuff for our nest than we possibly need. We all want to get out and travel and entertain and eat and what have you. So that we've seen a pretty big shift in consumer spending going from goods towards services. And that's caused what I think you'd call rolling recessions in some specific groups. But I would say, as you noted before, the overall picture for earnings has actually been remarkably resilient in the face of this interest rate decline. Earnings going into 2023, earnings for the S&P peaked out at about 240. We're down to about 250. We're down to about 220, 225 right now. But the consensus actually going through Q2 earnings actually feels better today than they did six weeks ago. So I think the picture is pretty good. Now, I'll add one more point that I think a lot of people don't know, is that this quarter will be the 5th quarter of down earnings. But the great news, I think, and I think it's the reason the markets, remember, we all on this call, I'm sure, agree, markets look forward, not backwards. And I think one of the reasons we've seen such a strong, robust market, even in the face of down earnings, is markets are anticipating when they're going to get better. And I think after looking, about 85% of the S&P have reported, the news has actually been really quite good. And I'll give you a stat that really makes me feel good about it, is earnings for the S&P this quarter are going to be down about 7% year over year, which doesn't sound very good. But what people don't realize is the energy sector, which is only about 4% of the S&P's market cap, had very huge earnings declines because the price of nat gas has really collapsed from last year when it spiked huge because of the Ukrainian war. So if you take out the big 25, 30% earnings declines that a lot of the big cap energy companies are seeing, earnings this quarter are actually up 2%. So we've actually gone from negative to positive. And when we look forward, those numbers are expecting the street's actually looking at double-digit improvements in the next couple of quarters. So I think things are getting better. It's just people haven't necessarily realized it yet.
So, Greg, to that point, Dom and I talked in the open about the market breadth and how it's been a few stocks been pulling the market along, and that was really true for the most of the year. And right before this little sell-off, the breadth really did improve, and the value stocks were getting better. The Dow Jones was improving. Where do you see for the rest of the year, market breadth? Do you see it still staying so concentrated, or do you see it spreading out a little bit?
Well, I think you can, like anything in the markets, you can make a case both ways. But I'll kind of give you some stats that'll help you understand which way I'm leaning on it. The first thing I'd say is, it's kind of classic markets 101. When growth is scarce, the markets will put a premium on growth. And when we've had 5 straight quarters of declines, well, I think one of the things, I think you guys have mentioned, maybe call them the Magnificent Eight, or JP Morgan calls them the Mag 10. But I would say it wasn't totally unrealistic why that happened. If you take a look at what happened, the Apples, the Microsofts, and anybody that was related to big cap tech had awful earnings last year. But starting in like the first quarter of this year, largely thanks to AI with respect to Microsoft and NVIDIA and some of the other big cap tech companies, they've really hit a V in their inflection point, and they went from seeing declines in their earnings to double-digit growth in both earnings and revenues. The market's not stupid. The market saw that, and because there was such a dearth of growth, we had kind of this crowding effect where they all went into it. So, but I would say, from someone that looks from an earnings and revenue perspective, was the markets crowding into just a few stocks irrational? No, it wasn't really. I mean, they went to where the goods were, so to speak. I think when you take a look going forward, though, I think one of the biggest bear cases that I read is there's some pundits out there that say, "Hey, the market's expensive now," and there are definitely a segment of the S&P that is, I don't know if it's overpriced, but it has pretty strong expectations built into it. But what's kind of interesting is if you take a look at the S&P with the Mag 8, without the Mag 8, the S&P is hovering around 19 and a half, 20 times earnings, depending on whose number you believe. If you take out the Magnificent Eight, though, the PE of the market's only 16 times. And so I look at it and go, okay, you have to correlate it with interest rates. And it's been, interest rates are at a 22-year high. So it's been a long time since a lot of us have seen these kind of rates again. But, history shows that when you've got a 5%, risk-free rate of return in the T-bill, the PE of the market should be in that 15 to 20 times range. So I think with earnings improving and the vast majority of the equally weighted S&P trading at 16 times, I think there's a very, very strong case to be made that we're going to see an improvement in market breadth over the next couple of quarters, if that growth comes through.
Just to follow up, to a benefit for our clients who may not understand the correlation, what you're really saying, Greg, is that you don't think the market is expensive as some other analysts believe. Is that correct?
That's absolutely. Thanks for, I'm a dork, so I talk a lot of jargon, but without question, it's, I would say the vast majority of the S&P is very, very reasonably priced relative to its earnings and revenue growth prospects. So, the key thing is we definitely need to see that inflection and that improvement that the street's looking for. But if it happens, I think you're going to see many more stocks participate in this rally than we've seen so far year to date.
So, Greg, you kind of opened Pandora's box when you said AI, artificial intelligence.
Sure.
And let's be honest, some of these 7, 8, 10 stocks have pulled back quite a bit in the last I'll say 4 weeks. But at the end of the day, these companies have to make money. I know they rallied high. Some of these things are up 100, 200% for the year, based on the idea of how much money they're going to make utilizing AI, artificial intelligence, in their business. And an NVIDIA, which makes chips, I get it. They got to sell the chips. They can sell every chip they can make. But some of these other companies, did they really deserve to go up as much as they have? Because at the end of the day, how long will it be before they can actually make money using artificial intelligence?
Sure. It's a great question, Dom. I'll tell you, I've been following technology since the late 80s. And I'll tell you, where I get excited about a new trend or a new technology is not the company that makes it, but when the user themselves benefit. And I'll tell you what I get most excited about AI, and is there a lot of hype in it? Absolutely. But I think when you take a look at the companies that are going to use it for productivity enhancements, I think we're really at the tip of the iceberg of what's going to be able to happen in white collar America. I'll give you a great example. We manage money for a large law firm, and I was talking to one of the senior partners, and he said, I asked all my clients, I said, look, if you have a real world AI experience where you see how it's going to help your business at the grassroots, I said, I want to know about it. Call me right away. We have to talk. So anyway, a senior partner of a law firm they specialize in patent law. He called me and he goes, Greg, you wouldn't believe the experience I had. He said, there's a software firm and a database firm called LexisNexis. That's kind of the industry standard for legal. And he said, look, I've got a new patent that I'm working on for one of our big clients. He goes, I'm going to have to search through 60 countries to see if this patent infringes on anything. He goes, our existing LexisNexis database is great for telling me what the potential infringements might be, but there's no intelligence in it. It's strictly just like a database. It pulls it up, and then they have to have, he said, a team of lawyers and paralegals. He said he'd take a team of paralegals, about 20 paralegals, about 3 weeks to go through and figure out if this company's new patent would infringe upon the old one. He said they showed them a new AI program that's under development that LexisNexis is doing, and he said it did it in 10 minutes. Okay, and I said to the senior partner, I said, well, I go, how accurate was it? And he goes, well, you don't take everything for face, but he goes, it was about 95% spot on. And I said, so what's your feeling about AI? And here's what I thought was kind of funny. He told me, he goes, tell your kid not to become a paralegal. Okay. So, that's just one example of many that you can go through where I don't think people I think the market's already on top of it. We're just in the infancy of how incredibly smart and innovative people are going to use AI to make to make their business better, faster, make quicker decisions. I think the part of the fear is, will AI replace certain jobs? And in some cases it might, but I think if you talk to, you take a look at some of the smartest consulting firms in the world, like Accenture, for example. Accenture's plowing $2.5 billion into an AI initiative. And they believe that it's not going to replace workers, but it's going to make people a lot more efficient. It's going to make their decisions quicker. And just think of the global repercussions of that. It's huge. And I think that, so is AI overhyped? In some cases, maybe a little bit in the short term, but I think in the long term, it might even be underestimated how big it's going to be.
Greg, I agree with you, but I also think what you just said is true. I don't think the human touch is ever going to go away. Coincidentally, I was doing a review this morning with an attorney as well. And we talked about AI because we talked about some investment ideas. And he said he knew an attorney in the States who used AI to cite case law. And the AI made them up.
Really?
They were fictional. Mm-hmm. And a judge kind of went to research them and realized that these are not real cases. And the lawyer is in trouble.
Sure. I could, if you're pulling bad data, I think part of the thing is if you talk to the Microsofts of the world that are really leading the charge, it's the quality of the database that you're using. And that's the big thing. If you have, it's kind of like if you've got bad data, it's garbage in, garbage out.
Yeah.
So I think one of the biggest challenges is going to be making sure that these large language models are built off of data that's reliable. And that's a huge challenge right now.
Greg, it's hard to believe, but half the segment's already over. Just got a nose from our producer. So let's take a quick break because Dom and I have a ton more questions we want to go over.
All right.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominic Tavella and our guest this evening, Greg Dalhman, Senior Vice President at Dana Investments. Dom, I think you had a question for Greg.
Well, more just to kind of maybe put a star on it, so this whole concept of AI, and like Mike, we're getting these questions every day. I think it is going to revolutionize the economy. I think and there might be jobs lost or maybe other people's jobs run more efficiently, but I just believe it might take some time, whether that's a year or 5 or 10. I'm not smart enough to know, Greg, but I just think there'll be some time lag between when it becomes a cornerstone of how our economy runs.
Oh, without question. And Dom, when we were offline, Dom had mentioned to me a fast food chain that's using AI. And I think part of the thing about AI, again, is there's a fundamental shortage of labor in this country right now, especially in the service industries. Fast food places. There's a lot of the resorts that I've traveled to or what have you are really struggling to find enough help. And I think, for example, there's a couple of large hamburger chains in the U.S. that are testing AI right now. And it's not like they're actually testing where you can actually use when you talk into the microphone going through the drive-through. The AI actually takes your order. And this AI really isn't designed to replace a body as much as the fast food people can't. Their turnover is so high and there aren't enough people that want to work for the wage that they can afford to pay, that AI augments the people that they can hire, makes them a lot more efficient and a lot better at what they do. So I think time will tell. The advances are coming quick and furious. So I think we'll be surprised at how quickly it comes.
And if I could just follow up on that, Mike, in jobs that people just don't want to do anymore, right? I always point at the trucking industry, who, God bless these people, but to sit in a truck and drive for 12, 14 hours a day. And, there are people who just don't want to do that job anymore. And so maybe finding technology that can do it for you, that could go a long way to making companies a lot more efficient.
Greg, just to switch gears for a minute, you guys are based out right outside of Milwaukee. Are people going back to work? Is the city vibrant? Are the restaurants full? How's the economy in the Midwest?
I think Milwaukee, I'm back to our clients are in 48 states. So I'm back to traveling again. And I would say Milwaukee's no different than almost every city I've traveled in lately. You can't find a reservation between 5 and 8 o'clock anywhere. Okay. So I think it really goes again to, though, the shift of our spending from buying stuff and when we were sequestered in our homes to we all want to travel. We all want to get out there and experience life again. So I would say very much so that you're seeing a pretty robust movement in anything service related, in entertainment, eating out, what have you. Everything's been very, very full. There's Wall Street Journal just had a great article just a couple of days ago that talked about that the coasts seem to be the place that people aren't coming back to work as quickly. They noted Chicago, which is a city right down the way from us. 4 or 5 days a week, occupancy in the office buildings is back up to about 60, 70%. I would say Milwaukee's getting there. I think we're coming back, and I think there's a reason for it. There's some jobs you can do remotely, but you can never, at least in my business, you can never really replace that face-to-face contact. So I think it's a good thing, and I applaud it actually. But maybe I'm a little old school too.
We're with you.
So, Greg, we've talked about some positives, right? The earnings have held up pretty well, and GDP seems like we're going to have another positive quarter on our way to another positive quarter. So at least no recession this year, technically. What keeps you up at night? What worries you?
The Fed, will they overdo it? I think they have to talk tough. and we've got the Jackson Hole meeting coming up. That historically last year was not a positive meeting for the market because, as you know, they really rattled their saber. I think they still need to. I think they're still worried that economic or financial conditions are going to loosen too much and make inflation harder for them to contain. I would definitely say, the two things that really keep me up at night would be, will the Fed overdo it? And number two is, I think China's in more trouble than people realize. And while a lot of strategists seem to think that China's contained, I'm living in the industrial Midwest, and very few products are made 100% in the U.S. I have a very good friend, for example, that is a senior executive with Johnson Controls. And we were talking this weekend, and they manufacture a lot of their parts here in the U.S., but some of their key components still come from China. So you can't make that go away. So I think one of the things I see is that as the Chinese economy decelerates, there's a chance that they're going to be exporting deflation, so to speak. And it's also, it's going to have an implication, especially on Europe. We know the U.S. doesn't export. We're more of a buyer of Chinese goods. The Europeans, on the other hand, export a lot of, especially autos, machinery, things like that, to China. If that slows down for them, it's kind of slow. It creates kind of like a ripple effect. They feel it first, but then our companies feel it. So it's something, I don't want to make it sound too alarming, but I definitely think it's something that's worth watching that people don't really have on their radar screens right now.
Greg, just getting back to the Fed, we're going to be knee deep in election season in the blink of an eye. And whether you're a Republican, Democrat, or an independent, I think we could all agree that this election season is going to be unlike any of us have ever seen in our lifetime.
Yeah.
And I think it's going to suck the oxygen out of the room every single day. Does the Fed pay attention to that? Does the Fed ever secretly say among themselves, we would love to be done so we could just get on the sideline and not be a part of this election cycle? Or do you think they just have to stay neutral and do whatever they have to do no matter the timing?
Mike, I think there's a really strong case to be made that, the Fed is supposed to be apolitical, but let's face it, they're appointed by politicians, okay? And there's a quid pro quo behind the scenes. We all know that. I personally think, and I think a lot of people that I respect have said that, the Fed moved more aggressively than what we've seen in many, many years by multiple 0.75% increases. I think part of the logic for that was to get it done before they got into an election year. So I think there's a really strong case to be made that that's one of the reasons they moved as aggressively. And I think they want to be done and they want to get out of the picture so they're not part of the whole political environment once it happens.
I would agree.
So I'm going to stay on the theme of the Fed here, and just coincidentally, I had to go look at what the prime rate was today, and I got to tell you, obviously we follow interest rates every day, Greg, but I was a little stunned to know prime is 8.5% today. Greg, 8.5%. And most of our clients are, whether it's an adjustable rate mortgage or a credit card, they're paying upwards of 9, 10, and credit cards 18%. I mean, these interest rates are real now, meaning they hurt the average consumer out there. And consumer debt is at an all-time high. So when does the pain finally hit?
It's a good question. I think a lot of pundits thought it would happen already. I'll tell you that, I have the luxury in my job of talking to CFOs and CEOs and what have you, that a lot of individuals, you don't get access to that. I'll tell you what, one of the biggest worries that I think has some justification for the banking system, though, is that just think about interest rates. I mean, I think, when you look at housing, I think most financial professionals before the pandemic would have said, if I would have told you that mortgage rates were going to 8%, you would say the housing market would go completely in the toilet. That hasn't happened. And one of the key reasons that hasn't happened, if you were fortunate enough or smart enough to lock up a mortgage in the 3% range or what have you, you don't want to get rid of that mortgage again. No,
you're not giving it up. You're not giving it up.
I talked to a corporate recruiter that handles, the C-suite type of things, and he said it's the hardest thing to move people from state to state right now, because if you've got a super low mortgage, you don't really have any incentive to get out of that. So I think what's that done is it's held down the supply of used housing. So it's really held up housing in general, and it's really held up the home builders too, because they're, when it comes to where's the new supply going to come from, it's really helped them. And to me, that's 180 degrees from what most financial professionals would have predicted before. I'll tell you what I do worry about a little bit, though, guys, is that there was a lot of commercial real estate where the cash flow from the properties made 100% sense when they could finance the property at 3 or 4%. Going right back to the numbers that you were spouting, though, I've heard from a number of bankers that said, look, it's not just office buildings that people are worried about, only being 50% occupied that aren't going to make their debt no matter what. It's 100% occupied apartments or shopping centers or what have you, that on the cash flow totally justified a loan at 75% loan to value at 4%. But if you move that interest rate to 8 or 10, not going to happen. And I think that's something I don't think the Fed has really dealt into their equation of how they could have an impact on the economy.
Greg, speaking of the economy, are you surprised that when Fitch downgraded U.S. debt a couple of weeks ago, that it basically was a nothing burger in terms of the media and the market reaction?
Well, we saw a one or 2 day market reaction, but I mean, let's face it, the U.S. is still the only game in town when it comes to the highest quality, and I don't think that's ever going to change. I mean, take a look at who else are you going to trust with your money if you want to keep it safe besides the U.S.? Maybe a couple of the key European countries, but other than that, we're the only game in town.
Tom, can I ask you one follow-up question?
Yeah,
I'm glad he
please,
said that.
Yeah.
So, Greg, I'm so happy you said that, because you just said something so succinctly. About a month or two ago, Dominic and I were both getting questions or concerns from clients in a certain news bubble, convinced that the US dollar was going to be basically devalued and China was going to come along and eat our lunch. And that is not remotely something that's going to happen anytime soon or ever, correct?
Agree 100%. I mean, if you take one of the things, I think that there's been some really good articles in the Wall Street Journal or Barron's or Bloomberg on this, but I think the U.S. has what's called the rule of law, and I mean, we take it for granted, but it's a beautiful thing. And take a look at China. It was just a couple of years ago that their premier Xi Jinping really decided to put a clamp on the private business sector. And there was probably a lot of publicity about Alibaba and how they felt like that company was getting too powerful. So the government really put the clamps on and really made their business hard. It happens in the U.S. to some degree, but it doesn't happen anywhere close to that. And it's never gonna, because we still believe in free markets, and let's hope we keep it that way.
And Mike, you stole my thunder a little bit, but I'm going to follow up anyway.
Sorry.
No, it's the exact same point, Mike. It's just a little bit of a different angle. So China's been working very hard on a global scale to make the Chinese yuan universal and used quite extensively. Look what just happened to the valuation of the Chinese yuan. I mean, you got your head handed to you.
Dom, I'm sure you probably talked about it in other podcasts. The Chinese average individual doesn't have their financial net worth is invested in financial assets as much as hard property. And China saw just an enormous speculation boom. And, they built, how many times have you heard about these cities that are half full, cities to nowhere, that there's a ton of debt in China that was used to build these, a ton of speculation. And we've seen it. We saw it in the financial crisis in the U.S. There's a really good chance that they're going to go through something similar to that in their own respective market. And for that reason, anybody that tells me that the Chinese yuan is going to take over, I'm like, not going to happen.
But you already brought this up, Greg. They are the second largest economy. They do an awful lot of exporting, but also importing. So things go downhill aggressively there. There's no way that we're going to come out of this unscathed, and including Europe.
No way. They're just too big. I think Europe exports a lot more to China. So I think in terms of if their buying slows down, it impacts Europe first. But we're all intertwined now. Whether we love it or not, globalization is here to stay. There are some trends moving in the opposite direction, but for the most part, supply chains are global. We learned that during COVID. We're not going to forget it. Are some companies trying to lessen their dependence on China? Absolutely. I mean, I've talked to like 4 companies in just the last 2 weeks that they're not necessarily reshoring back to the US, but they're moving production from maybe China to Vietnam, Thailand, Philippines, Mexico. So companies are trying to de-risk their supply chain, so to speak, which I think is a really good thing because we don't want to go through that supply chain issue like we did during COVID. But it's going to take decades for that to happen. It doesn't happen overnight. So what happens in China is eventually going to impact us. There's no question about it.
Greg, I know you're not a political scientist, but while we're talking about China, one of the other concerns our clients express to us is if the Chinese economy weakens, the Chinese government will not think twice about becoming more aggressive. Whether, the buildup of the military in the China Sea, invading Taiwan. I mean, are these things that keep guys like you up at night? Or again, are these things that just the talking heads on TV need to talk about?
I'm not the right guy to give you expert political opinions, but I would tell you guys that, for somebody that picks stocks, I would say that when I train interns or what have you, there's a lot of what I'd call a checklist that you go through. There's a lot of different things that you think about when you're evaluating a company. And truthfully, political issues used to be far down that list. They're farther up the list now. Okay. So, suffice to say, it's something I think every stock picker has to think more about than they used to. I'd like to hope cooler heads prevail. We manage money for a C-suite technology executive in Silicon Valley who has an operation in Taiwan. And, when I listen to him on his travels, when he comes back and, are the Taiwanese preparing that a war could eventually happen? Yeah, they are. But I think we all have to remember that, Taiwan specifically, over 25% of all the semiconductors in the world are produced in Taiwan. So if something like that happens, it has global ramifications and very, very quickly because semiconductors are in so many products that a lot of us just take for granted.
Oh, yeah.
As we saw through the pandemic, they couldn't produce trucks or cars or God knows what other equipment because they were missing one part, right? One semiconductor part. So we learned the hard way that it has global implications.
You bet.
So can I jump in, Mike, or Mike?
No, please.
So let's just switch gears because I can't believe we're already getting pretty close to running out of time. So both Mike and myself brought up that seasonally this gets to be a little bit of a soft period in the markets. You usually get a little bit of a pullback. Are you expecting anything, I use the word significant in pullback at all?
I think it's super difficult to predict what the market's going to do day after day. But I would say, you guys are right. There is a seasonal impact to the markets. I was just on a really interesting call with a couple of really smart hedge fund guys that, we were talking about, well, why is the market so seasonal typically in that August, early September period? Part of it has to do with some of the people that are managing big money are on vacation and are, they're not moving money around. That definitely has something to it. I think the bigger thing, though, has to do with, it's all a lot of stocks trade off of expectations, and if you take a look at analyst estimates for how most companies are at the micro level or at the stock level, analysts typically come out pretty optimistic. And then as the course of the year comes on, they kind of come back to reality, so to speak. I think one of the reasons the markets have a little bit of a correction in that typical August, September time period is we're now halfway through the year. So if analyst estimates were too exuberant, they need to take those down, and then stock prices react in accordance with that. Could the markets continue to have a little bit of a correction? Absolutely. But I would say, though, that the news from earnings that I told you all about earlier is better than we typically hear at this point in the year. So I'm optimistic that if we do get a 5 to 10% correction, it won't be long lived if what I'm hearing at the company level continues to happen going forward.
And let's put that in context. So we get a 5 or 10% correction. The S&P was up 20% in the first half of the year, and the S&P was up 30%. So wouldn't it almost be a little welcoming if we got a little bit of a pullback?
Dom, I'll let you touch on that one first.
Well, and if I can add to that, Greg, we track how much money is sitting on the sidelines. We're still looking at an insane amount of money sitting in money markets, bank accounts, savings accounts, afraid to go back into these markets. So if we got and I do think a healthy 5-10% is not unusual, or I don't think it would be much more than that, just because the money would come rushing in to buy the dip.
Absolutely. I would tell you guys, after being in this business since the late 80s, stocks are the only thing I can think of that when the price goes down, people want less of them. Okay. Almost anything else, the price goes down, you go, back up the truck, I'll buy another one. Stocks aren't like that. But, I was just talking to a friend the other day that was lamenting that he had been down so much in last year. And I said, how far do you have till you retire? And he said, I've got 20 years. And I said, you just bought a big block of stocks on sale, and that's only going to be good for you somewhere in the future. So, for those of us, and I think the vast majority of us have, 401k plans where the money comes in every 2 weeks, comes out of your paycheck, goes into the market. Corrections are good. It gives you a chance to buy at a more attractive price. So, we all want the markets to go up over the long term, but occasional buying opportunities I view as very healthy, and I actually welcome them, especially for me, because it gives me an opportunity to buy companies I really like at a price that's more attractive than it might have been just a week or two before.
We agree with you. We say the same thing. Greg, we have about 3 minutes to go. Any sectors that you either feel very strongly about, either bullishly or bearishly?
Well, I'll tell you, rather than sectors, guys, I'll tell you what I'm really amazed at is I think investors need to pay attention to the amount of innovation that's going on in this country. You've all probably heard about, some of the obesity drugs that Novo Nordisk and Lilly are coming out with. I mean, these could be potentially enormous changes to a vast number of people's population of their health and quality of life. There's biotech advances coming. AI has so many things going on. If you watch the media sometimes, you get a sense that things are bad. And I would tell you that the innovation that's happening in this country is accelerating. It's not decelerating. And innovation is good. It increases the wealth of all of us. It improves, especially in the healthcare area, it improves our quality of life and what have you. So I would say there's a number of sectors that it's not just one or two. I think just innovation is happening in so many different areas of the economy right now that I think there's a reason for more optimism than perhaps the media would relay to you.
And Greg, I know because we use one of your large cap dividend portfolios. Just large cap dividend paying stocks in general have underperformed so far this year. What are your thoughts going forward?
Well, like I said, Dom, those companies, they weren't putting up the double digit. Those were the companies, especially, the large dividend paying companies. The average company has 40 to 50% of their exposure overseas. And, overseas has done worse than the U.S. in terms of economic growth. So it's not surprising that those companies are seeing down earnings. It's not hugely down, but a lot of the high quality paying dividend stocks have seen year over year earnings decline by 5% type of range. Wall Street likes growth, so when those companies start putting up the goods again, they'll get rewarded for it. And I think there's a little bit of a springboard effect setting up because those companies are quite reasonably priced. So when they finally see that inflection point, and Wall Street can say, "Oh, that inflection really has happening," revenue is starting to revenue growth is starting to accelerate. Earnings are starting to accelerate. And I'll tell you that the unsung thing that I'm sure you guys have talked about in past podcasts is how much cash flow corporate America has and how much they're using it to not just pay us in dividends, but buy back stock, which benefits shareholders too. So there's so many good things going on that I don't think the media is really, I don't mean to sound uber bullish here. Maybe I'm coming off a little too optimistic, but I would tell you that I think that the media isn't picking up on some of the good things that are really going on out there.
Greg, we are out of time, and we appreciate your common sense Midwestern approach. And there's a beautiful blue sky over your shoulder. So we also appreciate your enthusiasm and your optimism.
Fantastic. Well, it's a pleasure to spend time with you guys. Have a great night.
Thanks for a positive voice and tone in all this. I think it's good for our clients to hear it. Thank you, Greg.
You bet.
Thank you, Greg. Have a good night, everybody. And Dom and I will be back next week with a new show.